came into 2025 pretty much market neutral. So it was late December of 24 where I sold a lot of my long positions. And the reason was not because of tariffs or I had some kind of, omniscient knowledge about Liberation Day, the level of duties that he was going to put on the rest of the world. Trump, I just thought the market was just not worth the reward where it was valued. So it was trading about 200%. Total market cap of equities as a percentage of GDP was around 200%. I just thought that the risk reward ratio wasn't there. So the market was pricing in 14% earnings per share growth. And then the multiple was 22 times that for 2025. In my opinion, based on the fiscal and monetary situation, that was unachievable. So I thought you had a few percentage points of an increase for the year, which is about 5, mid-single digits, but I could get 4, almost 4.5 on a short-term treasuries. So I was vastly underweight stocks. So we rolled into the beginning of the year and stocks were going up in the very beginning and then they started going down. February came and they started to go down further. And then we had March, April. April 2nd was Liberation Day. Trump announced these massive tariffs. I have 5 sectors in my investment bucket, from sector 1, which is deflation and recession or depression, all the way to hyperinflation or intractable stagflation. So we went quickly towards sector 1 because of these level of duties. The market started to crash and I got even more bearish. And then came April 9th, and I think Liberation Day level of tariffs lasted for like 12 hours because Trump completely capitulated. And then someone called him the taco president. Trump always freakens out, but at the end of the day, he's pro-market. So he realized that then it was an epiphany for him that asset bubbles had grown so large that they couldn't tolerate a very high level of taxes on imports. So he reversed course, and then I started getting more and more bullish. And now we're pretty much back to where I was. So I took off almost all of my shorts, and I'm back to where I was at the end of December of 24. So I believe the market, it has possible mid-single digits upside at the most. You're far better off in short-term treasuries. And please understand this, there is still a grand reconciliation of asset prices to come. And that includes business debt, it includes treasury debt, it includes the real estate market, and it includes stock prices. That is still coming. And it'll be the bond market. It's the debt markets. That's what my model myopically focuses on. As to when it's time to get net short the market again. It will happen. We will have another recession. Recessions have occurred since World War II about every 6.4 years. The last one was 2020. So we're going to have another recession. During recessions, the market usually crashes around 35%. Sometimes it crashes 80%. And I think the next time we have a recession, Powell will do, or whoever's in place at the time, because he's headed for the exit door, I think, in May of 26. Trump is getting rid of him. And he'll be replaced by an obsequious sycophant that will just slash rates to zero. I think that's when the problem becomes very evident, because long-term interest rates could and should spike out of control. And that's going to cause the next crisis. And that's what I'm focused on. So I have a 20-point model, and I myopically focus on financial conditions and credit spreads. So it won't be a surprise to me. See, all the market is based on insider information. People say, the market knows, like it's some ethereal, enigmatic force that knows all. No, it's the handful of people who run this world, who are, the multi-billionaires who have access to knowledge if they're going to launch a nuclear bomb or if their bank is going under because of distressed assets. Those people start selling or buying gold when they're going to launch a bomb. All my model does is pick up the arcane components of the market that detect what those people are doing. So I can act with them before, the poop hits the fan. Then CNBS will say, oh, look what's happening here. And by that time, the public starts getting scared. By that time, it's too late. So I'm looking at credit spreads and financial conditions. You will see junk bond yields spike in yield, so crash in price. People will be rushing into the short-term treasury market, not long-term. I believe the yield curve is going to explode to the upside. It's short-term debt that they'll be piling into. That's the spread I'm looking at. I'm also looking at other things, CDS spreads, and a lot of arcanes and components in the financial conditions index that I look at to let me know when the credit market is fracturing. And the credit market fracturing always precedes a recession. And that is when you need to get the heck out of harm's way, because this market, it's going down fast. But here's the thing. Knowing that I just said that, the smart thing to do is to own a lot of short-term treasuries. I do. Invest in the market in places that are working. I am. Precious metals like gold, platinum, been working very well for us. Some foreign stock markets working very well for us. And then the areas of the US stock market that are working for you. It's okay to ride this bubble. but do it with a robust model that can get you out and short in plenty of time. Because if you don't, you're going to miss up on whatever upside's there. If you don't have that, then just stay in short-term treasuries. Because this is, in my opinion, the market is not going to run away. I know there's people out there thinking that we're going to have some big, huge bull market. Listen, the GDP calculation has really just two inputs. It's labor force growth and productivity. Well, the labor force is shrinking and productivity shrank. So, I mean, yes, I think it's going to stop shrinking productivity. So you'll get a small boost in productivity, probably AI related, but you're just not going to get nominal GDP up near double digits. And that's where you need to generate 14% earnings per share growth. You know, earnings actually shrank. The NIPA table shows, in the Bureau of Economic Analysis has a calculation for corporate profits. They shrank in Q1. So I know that people are saying, oh, corporate profits went up. Well, that's because corporations are raising debt to buy back stock. Their margins are shrinking and their profits are shrinking. So it's all engineering that we're seeing going on here that can't last very long. So you're not going to get 14% earnings per share growth. There's no way you're going to get a 22 times multiple on that earnings growth. But that's what the market's priced in right now. It's just not worth it unless you're here with your finger on the trigger and you're monitoring the situation every day like I do. People are just getting out of the dollar. People are looking for a place to hide outside the world's reserve currency. You think about what our creditor nations have done in the past. So they get dollars for manufacturing goods and selling them to us. They get those dollars and they just recycle them in our bond market. It was great. You know, they had a strong currency, had a nice return on the treasuries. And then something broke a couple of years ago and it continues to break. I don't know if it's because we have sanctions and confiscations, because we have trade wars. Foreign countries no longer want to recycle their trade surplus into dollars. They're selling their dollars and they're buying gold and they're buying platinum. That's a good alternative, because if I take my dollars and sell them and buy platinum and I store the platinum in my own nation, I don't care what any US president says about imposing a sanction on my country, because I own my own wealth. They cannot confiscate my wealth. So that's one of the reasons why I think platinum is another alternative to the dollar. I think hard assets are going to scream higher, and especially in 2026. Do you think about what's going to happen in May of 2026? So we already have a condition where the Federal Reserve has a 2% target for inflation. And they've missed that target to the upside for 4 years. They're going to miss it to the north for 6 years. So there's still not going to be at 2% in May of 2026 when Mr. Powell's fired. There'll probably still be, unless we have a devastating recession, which is a possibility. That's the only way inflation is going lower. It's still going to be above 2%. And inflation has eviscerated the bottom 4 quintiles of consumers. So it's the level of prices that is so onerous and so damaging. So it's not that prices are coming down. People say, oh, inflation is down. It's the rate of change. So it's a second derivative of inflation. So it's not rising at 9, it's rising at 3. Okay, well, congratulations. But prices are still high. The level of prices has wiped out the middle class, and they're still rising above the rate that the Fed wants them to rise. And then you come to May of 2026, and we're going to have an obsequious sycophant take the place of Jerome Powell and slash interest rates back into negative territory in real terms. So there's going to be a mass exit, and this is going to take place no matter what's happening in the economy. President Trump wants interest rates down by 2 full percentage points now. So you can argue if that's the right thing to do or not, but it's not going to be helpful to inflation, the rate of change of inflation. So I think there's going to be a mad dash out of the dollar, especially in 2026. And I want to own platinum. I want to own gold. I might even want to purchase silver before that time comes. I think the Federal Reserve institution should be defunct, go out of business, and be very clear about that. We do not need a cabal of pretend faux omniscience to set the cost of money. That is absolutely ridiculous. It should be the supply of savings versus demand for money should set the cost of money. And the base money supply, which is what the Fed controls, all right, physical coins and currency and Fed credit, that should be set by the increase in the mine supply of gold, which is never more than 2%, which happens to be commensurate with labor force growth and productivity growth. See how beautiful it is? And then if a bank goes out of its way goes crazy with the fractional reserve system and gets over their skis, that bank should be allowed to fail. So we have creative destruction. You have a self-fettering mechanism then where you won't have these asset bubbles in place. You won't have a condition where the first-time home buyer has been completely priced out of the home buying arena. Home prices are unaffordable. That's disgusting. You hear Jerome Powell, everything we do is in the interest of the American consumer. Blah, blah, blah. No, you were buying mortgage-backed securities, Jerome, in the spring of 2022 when COVID was a distant memory? Why were you blowing up the housing bubble 20% year after year in price? For what reason? First of all, 1913, when the Federal Reserve was enacted, they only had the authority to, at a discount, take in treasuries owned by a bank, a member bank, right? That was it was never to buy corporate debt or junk bonds or mortgage-backed securities. So it's the Federal Reserve's fault for the inflation that has been inflicted on the American people. Make no mistake about it. And they know that. Everybody should know that.